The good news is we had rapid disinflation in the second half of last year, much faster than we had expected. So that's really good news, to around a 3% inflation level. And we had much stronger economic growth than we had anticipated. Those two things are a little bit puzzling. You would think if monetary policy is bringing inflation down, it would also be restraining economic growth, but we didn't see that. Now, in the first quarter of this year, conditions have changed a little bit. Inflation seems to have gone sideways, while economic growth has remained resilient. So it's led me to question, is monetary policy having as much downward pressure on demand as I would have otherwise expected? And one place I look at is I look at the housing market. The housing market has seen some evidence of slowdown. Mortgage rates have gone up a lot, but overall the housing market has also remained remarkably resilient, far more resilient than I would have guessed, having pushed mortgage rates, 30-year mortgage rates, up to around 7.5%. So when I look at this constellation of data, it makes me wonder, are there some dynamics of the reopening US economy that has led the neutral interest rate to go up, at least in the short run, so that instead of putting 2 feet down on the brakes, perhaps monetary policy is only putting 1 foot down on the brakes, or maybe it's not putting very much downward pressure at all. And so I was raising questions and laying out some of the evidence that I'm looking at.